Welcome to the Realty Rundown, the podcast that cuts through the noise of the real estate world. Your hosts, seasoned industry experts Nick and Nate, are here to guide you through the entire process. Each week, they're breaking down the latest market trends, decoding complex jargon, and sharing insider secrets you won't find anywhere else. Whether you're buying your first home, selling a property, or building an investment portfolio, we provide the clear, actionable advice you need to make your next move your best move.
All right, everybody, welcome back to the Realty Rundown with the Nick Wyse team. It's a shame you couldn't be here 5 seconds ago. You could have heard me yelling at my dog, please shut up, because we're about to go live.
This is true. I can vouch for that.
Challenges of podcasting. Oh, man. Again, welcome, everybody. I'm Nick Wyse, and with me, as always, Nathan Schwartz.
Yep, that's right.
We've got a big week ahead. So as you are probably aware, if you turn into this podcast at all, the Fed is meeting next week, and that means possibly a rate cut. I know many are expecting a cut in the prime or the federal funds rate. But what we want to talk about today is what exactly does that mean for your mortgage interest rate? Is that going to drop right along step with that? So today we're going to kind of unpack prime rate, inflation, recent CPI numbers, that is the consumer price index numbers, and how those all feed into your mortgage rate moves, or they don't.
Yeah, let's start with recent inflation. As of August, the CPI, or consumer price index, is 2.9% year over year. That's higher than the Fed target and still rising. Core inflation around 3.1%. That kind of inflation pressure often pushes rates up, or at least keeps them from falling much.
Yeah, that's it.
Yeah, and kind of switching gears here just a little bit, but prime rate versus mortgage rates. Nick, what is the prime rate and how does it relate to mortgages?
Yeah, so the prime rate is the rate that the Fed sets that they will loan from. So the Fed is kind of, I don't know, man. They're the man behind the curtain, I guess. So when the banks go to get money from the Fed, they have a rate that which they will loan it to them. Then it's up to the banks to turn around and loan it to us. And guess what? It's a higher rate that they loan it to us. That's part of the game, right? They're using money to make money. That's how banks work. So basically, the prime, it's for their customers, and it's typically set about 3%. Above, I'm sorry, not the prime, the bank rate is going to be about 3% above the federal funds rate. So it's not tied directly. And as we've seen in the past, sometimes it moves really independently. You know, when there was concern that the Fed was going to start raising the rates, banks started to trick theirs up ahead of time. And here we are, kind of a similar situation. And I hope I don't get repetitive with some of what we're going to cover later, but the word on the street is obviously that the Fed is going to lower the prime rate. So the banks have steadily, for a while now, been trickling down their mortgage interest rates. So while they're definitely tied, they're not directly correlated. And there's other things that can go on with this as well. There's a lot of variable rate products like your home equity lines of credit, your credit cards, your adjustable mortgages. If you've got an adjustable mortgage, we just talked about those recently. They're going to be using similar indices or similar rates as the prime, but again, not directly tied. So they're more influenced by long-term bond yields. Inflation expectations are huge. As Nate mentioned, CPI, numbers coming in higher. The Fed really wants to see that inflation number about 2%, which is really hard to achieve when you've got everything else going on that we have going on economically, tariffs, things like that. Really can make those costs, those end costs to the consumers fluctuate a lot more widely than we would like them to. So often the mortgage industry, obviously, they are keeping tabs on these things closely. So they're going to usually move ahead of the prime rate moves and in an anticipatory reaction, basically.
Yeah. So if the Fed cuts prime next week, what should listeners pay attention to so they understand whether their mortgage rate might actually fall?
Yeah. So more than anything else, watch treasury yields. I've got a little image that might help people understand kind of how this trickles, I guess, a little bit. So you'll enjoy that, Nate, when you get to look at it. But basically, watch your treasury yields, especially the 10-year. Watch to see if they're dropping. Watch the bond market behavior. If markets believe inflation is easing, that'll affect the bond markets. And then those CPI numbers, whenever they come in, pay close attention to those, because right now when we have this Fed that is kind of dovish and they don't really want to make reactions based off maybe political pressures, they'd rather look at actual numbers. The CPI is probably the major number that they're looking at. And then mortgage demand is huge. Lender margin shifts, but really, the one to focus on, the easy concept is that mortgage demand. Are people getting mortgages And then are they able to make money on those mortgages? If they're not, they're going to tighten, they're going to restrict. And so those are really the big drivers of this. I know it's a lot of complicated stuff. We're always going to try and come on here and make it as easy as possible. What is the information you actually need? Do I need to be a professional financial consultant? No, you don't. We're going to give you the information that you need. But
yep.
Just to tie it again to the episodes that we talked about recently with the adjustable rate mortgages, those mortgage markets will probably and typically do respond more quickly because they're tied to shorter term indexes. So fixed rate borrowers, they may not see a movement until there's strong downward pressure on those bond markets or strong inflation readings.
Yeah. So all this sounds technical, of course. So what do people actually do if they're looking to buy, refinance, or sell in a moment like this?
They call Nick and Nate and they say, what do we do?
That's right.
We say, we got you, man. We study this stuff. We love it. But really, if you've got a high fixed mortgage and you're happy with your payments, it's okay to hold right now. You don't necessarily need to go rush out and change your rates and look to capture the bottom rate right now. And then I'm going to do it again if the rates drop down. It's not free. So when you're going through and you're going to get a line of credit on your house, or you're going to change that mortgage, there's a cost associated with doing that. You're going to have to make sure that's something that you're happy with. The other possibility is that rates continue to drop. If you refinance now and they keep dropping, you're going to refinance every 2 years. It's not a good idea. So if you're happy, if you got a good position, your mortgage is affordable, it's probably best to hold right now.
Mm-hmm.
If you're shopping for a home, if you're out with Nate and you're looking at homes right now, expect to keep it up. Lock in a rate when you see one that you like, rather than waiting for cuts. As I've said 1,000 times, go open your front door right now, look outside. Do you live in America? You do? Then it's a good time to buy a home.
Exactly.
Generally speaking, don't try to be this prognosticator of all things. If you find a home that you want, do not be afraid of what the rates are right now. Get your home, because the chances are homes are obviously going to continue to rise in value. We've seen no indication that that's going to slow down. In fact, it's probably going to increase. So if you can get yourself into a home now, even if you didn't hit the very tippy-toppy bottom rate, you're going to be building equity at the same time. You're also going to be preventing, if rates do really go down hard, you're going to be preventing yourself from getting into a situation with a lot of other really anticipatory buyers who are going to drive up those costs even higher. Get your home now, start building equity now. If you're considering one of the arms that we've talked about, the adjustable rate mortgages, make sure you understand your margins, your caps, and how high your payments could go. There's obviously, as we talked about, CPI, that those inflation numbers are not what they want them to be. I do think they're going to lower rates next week. I really do. I think it's because there's a lot of pressure on them. Some of it's political. There's a lot of pressure out there, so they probably will lower rates, but there is a chance they will turn right back around and raise them. If they see CPI getting out of control, they're going to raise rates again. So in that regard, if you get an adjustable rate, just make sure you understand what can happen if those rates go up. And then sellers, if you're priced on anticipation of rates falling, you just may need to adjust your expectations. Rates could literally not move at all. And if they do move down, I doubt they're going to continue to move down. It would be surprising if they did. We would really need to see some things change in the overall macroeconomic landscape that we've got right now.
Yeah. So to sum it up, prime rates matter, especially for variable rate loans, but they don't automatically produce mortgage rate drops. Inflation, bond yields, and market expectations often lead, with CPI at about, again, 2.9% and recent mortgage rates falling to about 6.5%. We're seeing movement, but whether a prime cut next week turns into rate relief for fixed mortgage holders depends a lot more than just the Fed doing its thing.
That's it. Everybody keeps tying and keeps waiting and keep waiting. And we've seen the market be a little bit slow lately. Well, definitely kind of a lot slow. Yeah. As people are like, oh, well, let's wait and see what the Fed does. And then rates are going to go to 4%.
Yeah.
Not going to happen. In fact, here, I've got a picture right now. Got a picture, Nate, of a lady who is waiting. And you got to see that. She's been waiting. Meanwhile, her neighbor has purchased a home next door. There's jubilation. There's a lot of celebrating. The family's very happy. She is not so happy. So everyone who goes to the picture.
I can recall, I can't wait to see it. I can recall a year ago where people were doing this, buyers were doing the same thing, waiting for the rate to drop. If you're still doing that as you did a year ago, rates didn't move all that much. Last year till now, it didn't move much. So when you're ready to buy it, just buy.
Yep. Meanwhile, the price of that home went up 6 or 7%.
Yep.
Guys, come on. Give yourself the opportunity to start building wealth right now. Start building equity, creating that long-term value that is owning a home. So, Nate, you got anything else for us this week?
No, I think that's it.
Okay, we got a cool episode coming next week. The plan right now is we're going to talk to you guys about some of the home builders, maybe a national emergency in the home builders. We're going to see what they're really looking at. We're going to dig into that, something a little different than what we've done before. So please do turn in next week and every week, Monday mornings at 8 a.m. We will be coming to you live on the Realty Rundowns from the Nick Wyse team. Until next time, Nate, thanks for joining.
Yes, sir.
Call us up. Nick knows. Get your Wyse replies to all your real estate questions. Thanks, everybody.
Thanks, guys.
Yeah. Oh, yeah.
Let's break it down. Nick and Nate, we're running town. Realty Rundown, it's going down.